One.
Hello, everyone. Welcome to Finance Friday on the ARC UK YouTube network. It's springtime in the Rockies here in Jackson Hole as the last of the snow is melting in the shadows and on the hillsides. Here, coming up is a snapshot of taken yesterday from my back porch. That's the same porch that was under 9 feet of snow 2 months ago. These elk you see here are excuse me, guys, I got a little feedback. I got to get rid of it. My other monitor, see if I can do that. Sorry about that. Okay. Anyway, hope I did that. So these elk are kind of grazing on the green shoots that are coming up. As the spring approaches, and they've got better days ahead. They're getting fat and they're shedding their winter coats. And I wish we could hope for a similar optimistic transition as the CPI inflation slows down, and it is slowing down, and we look for better times ahead. However, as I'm going to point out today, I suspect that these elk have a little more reason for optimism on their grazing conditions than we do on the CPI. I'm Hard Money Jim, and as regular viewers know, this forum is dedicated to a very important but poorly understood topic, which is money creation and its consequences. And today I want to take a deep dive into one very obvious and important consequence of excessive and unproductive money creation, namely the increase in consumer prices, I should say, as measured by the Consumer Price Index, or CPI. And I want to examine where the CPI is likely headed, short term, medium term, and long term. And now, before we get into that, let's get acquainted with and understand the CPI itself a little bit better. Okay, on Wednesday, the Bureau of Labor Statistics, the BLS, published the most recent CPI annual increase. It came in at 4.93%. I take it you're all somewhat familiar with this number. The index itself is on the top here, shown on the slide. And as you see, it almost always rises except during recessions, meaning there's always some consumer price inflation going on. The chart on the bottom right is the annual percentage change in that index. This is the number that the BLS reports every month. It's the most common and the most popular measure of inflation. And in fact, most people equate the percentage change in this index number with inflation itself. You ask virtually anyone, what's inflation? And they're going to give you this CPI number. And so for the year ending April 2023, just reported a few days ago, people would say inflation is 4.93%. Now, regular listeners know that I think this is a misidentification of what inflation really is. But for simplicity, today I'm going to refer to CPI increases as, quote, CPI inflation. So thank you for permitting me the use of that, convenient term. All right, just a little bit of detail here. The CPI index is a weighted average of the price changes of various consumer categories. In effect, it's a basket of consumer items: food, shelter, clothing, transportation, education, etc. The things most of us consume to survive and just live our lives, with the items in this basket weighted according to what the BLS considers to be the spending pattern of the average urban consumer. I've circled the energy numbers on the right there, which were down significantly in the recent months. Declining energy prices brought the entire index lower than it otherwise would have been, but it was still near the total index change was still near 5%. Now, the index itself measures the cost of living at any given time, and the percentage number we get every month is the percentage increase in that index from its value 12 months ago. So we're talking about an annual change. So every month we get a number that expresses an annual increase in the cost of living from 12 months ago. So CPI is a rough measure in the change in the cost of living of a typical but non-existent consumer. No one person is exactly represented by this index. Its main value is to compare one period to another. So if we say CPI inflation today is running at, say 5%, and 2 years ago it was running at 2%, then we know we are seeing a significant rise in consumer prices. But it doesn't tell you much about your particular situation. All right, so the BLS also measures what they call core inflation. This chart is right off their website from yesterday, which basically excludes the most volatile prices, which are food and energy. So you can see that core inflation measured this way, that's the red line, has been pretty flat for the last 3 or 4 months. It's at 5.5% and not showing much tendency to fall back to the Fed's 2% target. So as the government sees it, core inflation remains at about 5.5%. Now here's a great graph that shows the effect of energy. That's the top in the turquoise, and food, that's the next space there in the orange, the effect of those on changes in the CPI. Notice that the upward march of service prices, that's in blue at the bottom, which are they're not yet leveling off. Now those prices, and let me get my mouse there, it's these prices right here. These prices are services, and they're dependent on labor costs that really have to stop rising before the Fed gets what it wants out of this inflation number. Now, just to emphasize the point that CPI does not describe everyone's inflation experience, here's data from several studies showing that middle-income households experience higher inflation in their typical consumption basket than high-income households, about 12% higher over the last 25 years. Data like this support the populist contention that the middle class is being, quote, hollowed out in the economy. In general, inflation redistributes wealth, and as it does so, it hurts the middle class more than it hurts the wealthy. It's not, this is true. It's not mere populism to complain about unjust wealth distribution due to inflation. It is a fact. And to make the point one more way, here's some data on college tuition costs. You can see there in the gold on the bottom, they're up over 860% in the last 40 years. Now, and you can see they're compared to other cost categories, like medical care and gas and apparel and so forth. So college tuition actually occupies a very small, almost tiny portion of the calculated CPI. However, if you're sending children to college, it is a huge expense. So you would obviously, in that case, have a very different CPI inflation experience than the official one. So the point is that everybody consumes a different basket of goods, and this basket changes constantly, even for every individual. So the CPI will not tell you the extent to which your personal cost of living is increasing. The CPI's best use, in my view, is that if it is calculated consistently month to month, you'll get a pretty good view on the directional changes in prices over time. So I say CPI is useful for watching trends. But you should also be aware that the CPI is systematically understates price increases through various means, such as the practice of so-called hedonic adjustments and periodic substitutions of cheaper products for more expensive ones. Now, I can't go into detail on this today, but just to take a simple example, suppose consumers are eating steak, and steak becomes so expensive that they shift to eating hamburgers. The BLS in that case, as they take their surveys, they'll start substituting hamburgers for steak in the index. Now, obviously, in that case, the consumer's quality of life, as expressed by the index, declined. After all, he's eating hamburgers when he used to eat steak. But so the consumer got, increasingly poor. But this incremental increase in poverty is represented in the CPI as a lower cost of living, which makes the consumer look better off. I think that's a rather perverse measure of price inflation, no? So there have always been these questions of whether the periodic adjustments to the CPI that the BLS makes, if these adjustments fairly reflect the inflation experience of the typical consumer. And so just for fun, I'd like to ask a question of all of you, and we're going to take a little poll here. So please, you can please respond on the poll that Daniel put up. The question is this. I'll give a forerun here. The CPI was created during World War I over 100 years ago. And between then and now, the government has revised its calculation methods 25 times. So the question is, how often have these revisions resulted in an upward measurement of prices? And stated differently, we're asking how many times has the government revised the consumer price index upward? And you have 4 choices there. So you can write in your number and share it with us. And while we're waiting for those answers to roll in, let me lay out where we're going to go for this talk for the rest of the day. I'll come back to that in a minute, Daniel. I'll let you summarize for me. So we're going to have a 3-part discussion of where I think the CPI inflation numbers are headed. And I want to look at where I think they go, that these numbers go short term, medium term, and long term. Short term for me is, say, 6 months, roughly to the end of this calendar year. Intermediate term is 3 to 5 years from today. And long term, I would say, is up to 10 years from now. And now I caution you that any projection of this kind is speculative, and it gets more uncertain the further you try to look out into the future. But anyway, with that disclaimer, I want to lay out what I think is a logical and plausible scenario for consumer price increases over those time periods. All right. Let's look first now at the viewer's response to the poll. Daniel, I don't see a summary there.
So far, it's 40% for 0 to 5, 20% for 10 to 20, and 40% for 20 up.
Well, I would say that the plurality is pretty smart, because the actual number of times that the government has revised the CPI upward when it revises is 0. Every single revision has stated the CPI to be lower than it was before the revision. So, anybody who thought 0, I know they didn't ask the poll that way. According to Grant's Interest Rate Observer, the government has every time revised its calculations to make the numbers look better than they were under the previous calculation method. And so, remember that when we get to talking about financial repression, because the government is going to want to make inflation look as much in their favor as possible. All right, so anyway, now on to the short-term CPI movements. Let's see where they're likely to go for the next few months. In preview, my position here is going to be that CPI inflation will be persistently higher than it was pre-pandemic, but also volatile when viewed monthly. And this persistently high and volatile measure is likely to continue past the short term that we're talking about now and into the intermediate and long term. All right, so you can look at these bars here, which are monthly CPI numbers. To determine the annual CPI inflation at any given month, the BLS adds up the last 12 months of monthly index changes. So as of April 2020, as April 2022 rolls off, just like it did a few days ago, April 2023 is added on, and the other trailing 11 months stay in the new index number. This is the so-called base effect on the CPI. So, like I said, CPI was just updated on May 10th, adding in the April 2023 number, which was almost the same as the April 2022 number. So the new calculated inflation number was 4.93%, virtually unchanged from a year ago. Now, this lagged base effect is, if you look at the pattern there, is setting us up to get some interesting inflation statistics over the next few months. If you look at the red bars, the CPI numbers for May and June of 2022, you can see that these numbers are very high. May and June 2023 will likely be much lower, which will lower the 12-month trailing CPI numbers considerably as the May and June 2022 roll off and May and June 2023 come on. But even after that, as we get to July, we're going to have the opposite effect. As we have very low numbers, we actually have zero from July of 2022 and a low number from August 2022. So those will go out of the CPI, and while July and August of 2023 will come in. So with all of that said, I hope that's clear what's happening there. What exactly can we tell what the CPI look like when we look at it month to month as we proceed to the end of the year? No one knows for sure, of course, but a reasonable scenario is CPI inflation will look like about 3% in July, but then can move back up to 5% by the end of the year. Now, this graph here is a projection by the Federal Reserve Bank of Cleveland based on their estimates of upcoming monthly CPI changes. By this projection, CPI looks pretty sticky through the end of the year. I caution you that a surge in energy or food prices could easily upset this projection, but barring that, I think it's reasonable. Now, this short-term estimate is useful because it might help us understand what the Fed is likely to do. Despite all the recent bank failures for which the Fed has been widely criticized, Chair Powell remains adamant that he will hold short-term rates high for a while longer. And likely he'll even do one more rate hike, and likely he will not reduce short-term rates at all this calendar year. So his own people here from the Cleveland Fed are telling him consumer prices are going to continue rising. So Chair Powell is committed to continuing increasing rates for at least one more cycle, although he may pause for a few months before he does it. Now, to give you an idea of what the Fed has been up to, this chart shows the Fed has raised its benchmark rate 5%, fully 5% in 50 months. That's shown by the yellow line on the left of the graph there. That is much higher and faster than at any other time, any other rate hike in the Fed's history. So Powell's words and actions both are telling us that he's determined to break the back of consumer inflation, and not to go down in history as the guy who brought high inflation back after everyone thought deflation was the real, including him, thought deflation was the real problem. That was only 2.5 years ago. He thought deflation was the real problem. So I think he's committed to killing the CPI and killing it as fast as he can. And it's going to take more than just a few failed banks to get him to reverse course and start cutting rates again. He needs to see a modest, at least, increase in unemployment and a tapering off of consumer price increases, especially in core CPI, or they have a slightly different measure they use, core PCE, which, as I mentioned, has not yet budged. Recall the Fed focuses on two things: unemployment and consumer prices, because that's the Fed's dual remit, low unemployment and stable consumer prices. In the world as Jay Powell sees it, he has to trade off these two things against each other to optimize his position. And right now, he still thinks the labor market is too strong and CPI inflation is too high. So he's going to raise rates, cripple consumer demand, put downward pressure on consumer prices, reduce that'll cause some reduction in investment, all of which will decrease, he thinks, the rate of employment growth, which will bring down core price inflation. Those are kind of the tools he has, and that is his plan. So unless something, big breaks in the economy and the Fed feels like it must immediately pivot and reduce short-term rates, I expect CPI inflation to hover in the 3 to 5% range till the end of the year. Again, that's well above the Fed's arbitrary 2% target. So there's a long way to go before the Fed can declare victory. I would, however, expect them to take credit for progress if, as we just saw in the little graph, the CPI increase dips to 3% this summer. Some pundits and politicians have already declared victory, and they're criticizing the Fed for staying too tight for too long. Just yesterday, I heard a television pundit say that inflation, by which he meant CPI increases, was, quote, yesterday's problem, meaning it's not important anymore. Well, I'm pretty sure he's wrong about that. Okay, let's see what we have in terms of, yes, thank you, Jonathan Honig, for your generous, Christopher Smith, thank you, 200 Swedish kroner, thank you. You guys are great. Gail says, it seems like, Chris says, yikes. Gail says, it seems like such an obvious lie not to include food and energy in these CIP charts. Yes, doesn't it? Prices are moderate, except for the ones that are going sky high, or for the ones that are going down huge. So I don't know, they believe that these prices are food and energy are highly volatile and they distort the long-term trend. That's their rationale, but I agree with you, Gil. Okay, let's look now at this very interesting section I think I prepared on intermediate term CPI. What about the intermediate prospects for the CPI? And I hope you're not boggling out with this chart here. I think here there's a good chance for the medium term that we're going to have fairly high CPI for several years. And to make that case, I'm going to show you an updated chart from Lynn Alden that I've used before. And but today I'd like us to take a close look at it and kind of let the data on this chart sink in. This chart attempts to show the effect of the growth of broad money supply, or M2, on consumer prices. M2 consists mostly of bank deposits, but it also includes currency in circulation and retail money market funds. Each point on the blue line marks a rolling 5-year percentage increase in money supply per capita. So look at 1943, that great big peak in the middle of the chart. And this tells you that in the previous 5 years up to 1943, broad money M2 divided by the population grew by 95%. Okay. Now this, that's an example so that you know how to read the chart. Okay. Now this rolling 5-year growth number is important because it takes into account the fact that increases in the quantity of money do not affect prices immediately, but work with a lag of several years. So you want to see a buildup before you expect to see over years before you expect to see a big change in prices. Now the per capita adjustment is important because actual consumer prices already, which you're comparing this to, already reflect the effects of population growth, but money supply by itself does not. So a per capita adjustment of money supply is a better comparison on the effect of increased demand based on the actual prices of goods and services. I apologize if that's a little technical. So if it doesn't make sense to you, I suggest you go back and read the transcript after this podcast is posted on my Stack. You think about it and you still have questions, write them in the comments and I'll be glad to discuss it with you. But anyway, back to the chart. Notice that as you move through history, the growth in prices lags the growth in money supply by several years, sometimes by longer than just a few years. And notice the increased growth in CPI also persists for years. For example, from the mid-60s to the mid-1980s, we had high rates of increase in M2. These were followed with a lag by high rates of increase in the CPI from the late 1960s to the late 1980s. And notice also that there were two periods when we had high growth in M2, followed by fairly subdued consumer price increases. The first of those was during the late 19th century down here, see, leading up to World War I, when there was so much growth and wealth building in the country that the increase in goods available for sale overwhelmed money creation, resulting in declining prices until the turn of the 20th century. So I repeat, and please note, despite significant money growth, we had declining consumer prices in the late 19th century. Now, I want to add parenthetically my belief that a condition of gradually declining consumer prices rather than our modern expectation of continually rising prices is the natural order of things under a free or nearly free banking system and a free or nearly free economy. All right, now, the second period of subdued consumer price increases, even in the face of significant money supply growth, is the period up here from late 1990s up to 2020. You can see Lynn Alden, who constructed this chart, attributes this more gradual level of price increases here on the orange line to a great productivity increase from China and other offshore producers. This is a phenomenon she labels offshoring. So what happened, she says, was that a surge of inexpensive consumer goods brought about by efficient manufacturing from offshore gave us so many goods, to sell that the price stayed low. So it's not too dissimilar to what happened in the late 19th century for a slightly different reason. Now, I think Lynn is correct that productivity from offshoring was a big factor in holding consumer prices down, but I think there was another factor, and that other factor was quantitative easing, which was responsible for a good portion of this increase in M2 that you see right here. Now, let me explain that. The graph shows that money supply rose rapidly in the early 2000s. But the question is, where did that money go and where was it spent? As I've documented several times in this forum, much of that new money was spent in the investment market and went straight to asset prices, stocks, bonds, real estate, and so forth. Most of the new money created during QE, and that is this period right here, this little bulge right here, was not spent on, most of that money was not spent on consumer items. So this spending could not show up as an increasing CPI. So in addition to the increase in the supply of goods brought about by offshoring, QE is another reason, in my view, that a rapid increase in the money supply was not able to produce the much higher CPI increases because the new money supply just simply didn't flow into consumer spending. During QE, we had price inflation in assets. We had inflation, all right, but it was in assets, stocks and bonds and real estate, not in consumer goods. Now, that brings me back to why I think CPI inflation will persist for the intermediate term. For several reasons. First, the recent 5-year cumulative growth in M2, that's way up here. It's not fully shown in this chart, actually. This chart stops at 2021 or mid 2020, I think. The recent 5-year cumulative growth in M2 due to this pandemic stimulus on the far right there has been huge. And given the lag in the effect of the money supply, given the lag the effect of money supply growth has on consumer prices, I expect the big surge in money supply of recent years will exert upward pressure on consumer prices for several more years, as it has in the past, before consumer prices finally settle down to a new high level. And second, the productivity surge from offshoring is probably over. It's now likely in decline. Today, we're talking about reshoring, as political tensions between partners like our trading partners like China and Russia kind of boil up. So production from offshoring I believe, is not going to any longer exert downward pressure on prices. And third, when the Fed's money printing resumes, and I think it inevitably will, it's unlikely that the new money they create then is going to be directed toward feeding and fattening Wall Street, as was the case during QE from 2009 to 2020, and really actually during the Greenspan era, even before that, but not as dramatic as QE. I mean, everyone now knows that the QE of 2009 to 2020 did not revive the economy as it was intended, but it did cause an unfair redistribution of wealth. And I suspect the Fed is at least a little ashamed of that. So at least some of the Fed stimulus in the future, and there's going to be plenty of it, believe me, will likely go to targeted companies or industries to keep them alive as they struggle against higher interest rates. New money created by the Fed will likely be more specifically targeted rather than just massively flooding the capital markets with new money. That is exactly the nature of the Fed's new recent credit facility that bailed out Silicon Valley Bank and a few others. And you could also expect the Fed to lend directly to critical industries or purchase the bonds of key industries to keep those industries alive. So higher interest rates as higher interest rates continue to bite in the economy, what I think is that will happen is the Fed and the Treasury are going to let unimportant zombie companies like AMC Corporation and Bed Bath & Beyond go bankrupt, but I doubt they would ever let American Airlines go under, as it just seems too important to fail, in their view. The big point is the Fed is not going to quit printing money. They're going to simply do it, as I see it, in a slightly different way. So, now I want to briefly address a reasonable objection to this argument I just made. Here's a chart of M2 for the last 30 years, and I've shown it to you many times. The rapid rise in M2 since 2020, that's the bulge on the right, is from the pandemic stimulus program. And it's responsible for the recent surge in CPI inflation. I think we all know that over the last 2 years. But way over in the far right, notice the line has started to roll over. So you can see that broad money supply has begun to decline in line with the Fed's current qualitative tightening program. So the objection to my argument for a prolonged CPI inflation is that as this money supply declines, total economic demand also declines, and this exerts downward pressure on prices. Now, under normal circumstances, I completely agree with this pattern of argument. It's true that a real decrease in money supply will eventually exert downward pressure on prices somewhere in the economic system. But in the present case, I have my doubts about that for 2 reasons. And the first is that whenever the Fed needs to step into the economy to save a zombie bank or a zombie company or an entire zombie industry, they create money to purchase zombie debt usually zombie bonds, or they can, as I said, they can even loan directly to a zombie company. But either way, this always involves money creation, similar to QE. And each time they do it, it has an upward effect on money supply. So if I suspect that if the economy suffers too badly from lack of money, the Fed will try to step in and save it, and it will not let this money supply roll over too far. So as the Bank of England points out, I give you a quote here, one major purpose of QE is to maintain an adequate level of money supply in the economy when banks are not doing their job. So I doubt the Fed's going to let the money supply decline too much. Now, second, and more important, actually, the reason I think this argument may not be right, this counter to my argument may not be right. It's not clear to me that this recent decrease in money supply is very important at all, given that there are now new ways that people have to hold money. So M2 just adds up paper cash, bank deposits, and retail money market funds. But over the last few years, the Fed has introduced another way, that you may not know about, to hold cash that does not show up in M2. I'm speaking of what they call their reverse repo facility, in which selected investment banks and investment funds can lend their bank deposits directly to the Fed. When they do this, their money flows out of bank deposits. It goes out of M2, and it goes into the Fed as an overnight loan on which the Fed pays them interest. Now, this is not actually spendable money, but it can become spendable with only 1 day's notice. Now, we're talking about a lot of money here. We're talking about $2.2 trillion in this reverse repo program on a total money supply of a little over 21 trillion. So it's not clear to me that this decline in measured M2 is going to have the same kind of deflationary effect that it would have had before the Fed's repo program, reverse repo program was available. So that's a kind of technical point that I will keep an eye on. Just to summarize this mid-range outlook for the CPI, the main point is that I think there's still lots of money in the economy in cash or cash-like balances that hasn't yet been spent on consumer goods, but could easily do so over the intermediate term, that is out 2 or 3 or 4 years from now. So barring some rapid increase in productivity on the scale of the Western settlement or the offshoring era, I don't know, maybe we'll get a productivity surge due to robotics and artificial intelligence. I don't know, you tell me. Barring that, a continuing steady increase in the CPI seems likely to me. All right. How are we doing on time here? Oh, we're good. And let's see. Edmund, Fed raises rates by a quarter point by Jesse Baines. Yep, they raised rates Wednesday. That's right. And Edmund, don't see a question there. You guys are funny. Not what side of the bed did Caesar wake up on? Okay. I can see you guys are chatting to each other rather than questioning me, and I think that's great. All right, so what about the long term, looking out 8 to 10 years on the horizon for the CPI? The overriding economic problem over the long term is our unpayable sovereign debt. And this is only going to get worse, I think, over the next 10 years. You'll recall I did a podcast called Uncle Sam's Unpayable Debt, explaining why I think we're never going to pay it back. I believe the unpayable debt problem is going to be the main driver of CPI inflation for the long term, which I now want to explain. Now, to tee up this long-term discussion, I'm going to point out something that your inquiring minds might have already noticed. You might have noticed a big difference between what Jay Powell and the Fed want versus what Congress and the Treasury want. the Fed's tightening policies are striving for higher interest rates and lower CPI inflation. But what do Congress and the Treasury need to fund the required expenditures that are already baked into future federal budgets? You guessed it, they need low interest rates and high CPI inflation, exactly the opposite of what the Fed is currently trying to accomplish. Now, since I don't see any way out of this debt dilemma for Congress and the Treasury, and since the Congress and the president hold ultimate power over the Fed, it seems inevitable to me over time that Congress must dominate monetary policy and the Fed must become less independent and more subservient to Congress. I think this process is already underway. I think we saw it during the pandemic stimulus programs where the Fed basically worked for the Treasury to get money to the masses. Over the long term, the Fed is likely to do bidding of the Congress and the Treasury, and that means that the Fed, will likely cave on their 2% consumer inflation policy goal and evolve to some other policy that allows for higher consumer price inflation, I don't know, say in the 3 to 6% range. At the same time, to help facilitate the government's ability to continue paying interest on the debt without busting the budget, the Fed and the Congress and the Treasury are going to have to do everything they can to keep interest rates below the level of CPI inflation. Now, that combination, as you know, is financial repression, which I covered in detail in January 7th in Money Creation, the Disease, and the Cure. So let's now go back and review the basics of financial repression, which will help us organize our thinking so that we can anticipate what the CPI inflation will be for the next 10 years or so. So first, very long term, 10 years and out, we know our existing sovereign debt, including both the 32 trillion of Treasury debt, plus all the built-in future spending obligations, cannot be paid in dollars valued at today's purchasing power. In my January 14th podcast on Uncle Sam's unpayable debt, I conservatively estimated the present value of the government's total financial obligations at $100 trillion. Just a couple of days ago, the famous investor Stanley Druckenmiller and his research team estimated the U.S. total debt is worth $200 trillion. So, is it 100 trillion or 200 trillion? It doesn't matter. Either way, the balance sheet of the entire world is not big enough to fund this level of debt. So the problem can be resolved in only a few ways. One is a hard default on the debt. The government would just simply declare that all these obligations, or maybe most of them, are null and void. Another possibility is hyperinflation, in which the debt would be quickly paid off in worthless dollars. Now, I would call both these possibilities the pitchfork solutions, because hard default or hyperinflation would be extremely destabilizing to the body politic, and it likely would involve a populist uprising, likely including violence, in my view. So as ignorant as our politicians are, I don't believe they are going to wait for things to get this bad. Their political survival instincts will not allow it to happen. But the third option is some kind of soft default, which would consist of a combination of policies, including significant inflation, but not hyperinflation, and suppressed interest rates for a number of years, possibly accompanied by some reductions in the rate of increase in spending if the politicians can make selective cuts and still manage to stay in office. So I'm convinced that their answer is going to be this last option, this third possibility. Our politicians and bureaucrats are going to figure out how to pay these entitlements. In doing so, they are going to do all they can to increase nominal revenue and to minimize costs. And they will have to pay these obligations with debased dollars, because there's not enough real wealth in the whole world to borrow, what it will take to pay for the promises that they've made. So we're talking about an inevitable, necessary, built-in inflation, money creation that is both excessive and unproductive. Okay, I say it's baked into this giant cake. This debt problem, the long-term debt problem, is growing more visible daily. It's highlighted by the current debt ceiling debate, which I'm not that concerned about at this point. The near-term debt ceiling fight, I think, is mostly theater. The debt ceiling will be raised. It will avert an immediate crisis, but it does underscore a growing urgency to address the long-term debt problem. So let's review in summary form from our podcasts of October, January, February, how financial repression works. And we could step through the things that government has to do to pay down this debt in nominal terms. And we're going to look at it from the government's point of view, as the government's problem in terms of cash spending requirements, outflows, and cash revenue sources or inflows. So on the government's cash spending side, we basically have two categories: the spending in the budget, which is mostly entitlements already written into law into the future, and interest. The second category is interest on the federal debt. So let's look at spending first. There isn't much Congress can do about spending. They really can't cut entitlements very much, or they lose their jobs to someone who will keep spending. That's why both sides of the aisle are tripping over themselves these days to claim that they will never cut Social Security or Medicare in any major way. They make little tweaks here and there, such as like small cuts in the defense spending, or means testing for Social Security, or perhaps a work requirement for able-bodied people who are on welfare. But these things can only make a dent in the massive debt and obligations we have. Now, the government can disguise some new spending as bank lending. And this will tend to be a kind of inflationary money creation that replaces, to at least some extent, productive money creation. The advantage to the government in this is if they can command the banks to lend to their favorite cronies, the new money does not show up as a budget item. What could be better than to supply patronage, the power to give out government jobs, contracts, and favors, and so forth? What could be better than to supply patronage without taxing anyone? That is a politician's dream, so I think you can count on it happening. It already happened during the pandemic stimulus program with some of the guaranteed lending programs. Okay, so now let's consider the government's other cost category, interest on the debt. As you can see from this graph, it is running away. The present annual debt cost is at $930 billion, and it's greater than the defense budget. It's about 15% of total annual spending and rising rapidly, and it's about 30% of revenue from taxes and fees. The government does have the power to suppress interest rates by regulation or legislation or both. And I think the Fed is going to help by manipulating key rates like the 10-year Treasury rate, perhaps through yield curve control, which did work for the Japanese central bank for decades. So on the spending side, expect the government to tweak expenses where it can, which won't be much, but most importantly, to minimize interest costs by suppressing interest rates. Okay, now let's consider the government's need for cash inflow. Those were outflows. Let's talk about inflows. And here the government is desperate to raise tax revenues and continue borrowing, because if they can't, they'll kill. If they can't tax and borrow enough, they are going to be seen as cutting financial benefits, and that will kill their careers, especially if it's to key constituents like teachers unions and the AARP and so forth. Politicians on both the left and the right are of the same mind here. The spending spree of recent history has been fully, don't kid yourself, it's been fully bipartisan. with only minor disputes on what the inflated money is going to be spent on. So if you're expecting the allegedly fiscally responsible Republicans to cut spending, think again. Now, to be sure, the public also has no appetite to cut entitlements. So whoever proposes big draconian cuts either will not be elected or they're going to be thrown out of office by the voters. So it seems very unlikely to me that a majority of Congress is going to agree to cuts in entitlements, which are 70% of current and future spending. So back to the cash inflow. Where is the government going to find the cash? They can only tax and they can borrow, and they must maximize the cash flow from both of those sources. Now, on the tax revenue side, the tax side, the government needs high consumer inflation to expand GDP, resulting in higher nominal incomes that allow them to collect higher nominal taxes so they can pay their promised obligations in those depreciated dollars. Recall that the amount government can raise taxes is limited as a proportion of GDP. Historically, in the USA, this limit is about 20% of GDP or a little less. Now, maybe they can raise a little more in taxes than that, but there's definitely a limit somewhere. And this means that the government must stimulate strong growth in nominal GDP to generate more taxable income. But to increase nominal GDP, they have to stimulate much more economy-wide final spending, because that's what GDP largely measures, as you see in these component numbers here. Almost 70% consumer expenditures. To goose GDP, to goose it up, they have to get people to spend more. To get people to spend more, they have to get new money into the hands of the spenders, mostly consumers, but also anyone else, such as various government agencies, who spend money on the goods and services that make up the spending categories in GDP. So keep in mind that most of the money that people spend is in bank deposits. That's mostly what modern money is. So new spendable deposits must be created in the banks. The question for economic planners becomes, how do you get the banks to create more money? Remember that all bank deposits are created either by bankers' market-based investment decisions, which I call good money creation, or by the government's regulation or legislation that encourages or coerces the banks into creating money. That's bad or inflationary money creation. So here's the problem. Since there are simply not enough sound investment decisions to create enough sound money, meaning non-inflationary money, to support all the required government spending, the government's going to find it necessary to intervene in the bank's lending and investment decisions. I expect they'll use both the carrot of encouragement, like loan guarantees, and the stick of regulation, new regulations and new laws that will force the banks to buy more government bonds and make more government-directed loans, thereby creating more deposits to create more spending, to boost GDP, to increase taxable income, to raise more revenue, to pay down the debt in cheaper dollars, to gradually get the debt to GDP ratio back down to a level, more reasonable level, acceptable to the bond market. And this will be the draconian but logical path to a more sustainable fiscal condition, and it will probably take some years. All right. Finally, how about the other source of cash flow, government borrowing? We've already pointed out that the government needs to suppress interest rates to keep from busting its budget with runaway interest costs. But in the face of very low real interest rates, investors, including foreign governments, are going to be very reluctant to buy our bonds. They already are. Now, because borrowing is such a large portion of the government's cash flows, currently borrowing covers about half the government's annual spending budget. Interest costs are soaring out of sight. Annual government interest costs are now, as I said, $930 billion. That's greater than the defense budget. 15% of the overall budget, 30% of revenues derived from taxes and fees. And the Fed's current tightening program is raising interest rates and making this even worse. Eventually, interest could overtake all revenue sources, obviously an impossible financing situation. So who's going to lend to Uncle Sam at these low real interest rates? Foreign buyers of U.S. debt are becoming more reluctant. For example, China's treasury holdings peaked 10 years ago and have been declining slowly since then. Because of this high and rising debt, at some point, the competitive bond market is going to limit our ability to borrow more. The government will therefore need to look at our domestic savings institutions, banks, insurance companies, pension funds, probably your IRA, to buy its debt at low interest rates. And they can accomplish this by a combination of force and persuasion, by law and by incentive, by the stick and by the carrot. This is almost exactly what was done by France and Britain post-World War II to pay off their war debts. Now, the great monetary economist Russell Napier is probably the best explainer of this scenario. And I have a quote by him here. He says, commercial bank balance sheet growth will remain, but perhaps more importantly, if it does not, government will take action to make it return. Only a move to force higher bank credit growth and money growth is likely to bring the higher levels of nominal GDP growth, which politicians so crave. That's why a move to secure such an expansion in bank credit is the more likely monetary response. All right, so bottom line is that logic dictates that many domestic financial institutions will have to buy government debt at suppressed interest rates. By suppressed, I mean interest rates that may be higher than today's rates, but still lower than the rate of GDP price increases. That is, interest rates lower than CPI inflation. That, my friends, is financial repression. Sounds a little gloomy, and it's obviously not great for capitalists, but do not despair because the world goes on and will survive. Banks, the creators of money, are becoming the next great tool of state planning. It's central planning through illicit money creation, what I would call creepy monetary fascism, but yet through it all, take heart, because there will still be a measure of productive lending, real production, and perhaps even periods of positive, albeit slow, real economic growth. Now, to let you know why I think our monetary managers know what they're doing, here's a quote from good old Christine Lagarde. In other words, you read this. In other words, she's saying, shut up about the fact that real saving is impossible. Stop complaining, get back to work, and do your share for the great financial collective. Sorry, I couldn't help myself. I had to take that shot. All right, so we're about run out of time. Can I go a few more minutes, Daniel, or do you have a hard stop?
No, you can go a few minutes over.
Oh, that's great. I'm so long-winded. You're going to get tired of me. I wanted to update you on gold. And so let's do that. Let's do a quick update. It's the go-to asset for financial repression, as you know, at least that's what I think. And you can review my podcast of that March 4th, why everyone should own gold, if you want a full rationale. So you can see here that gold has moved up to above 2,000, matching its old kind of all-time highs. So it's starting to do its job. And in currencies that are weak relative to the dollar, gold is at an all-time high price. So it's definitely doing its job for holders of currency like the British pound on the left there, and the Japanese yen on the right. So the price of gold is up, but please do not assume it will go straight up. Maybe it'll continue this in the current rally it's in, maybe not. I haven't even checked the price today. I don't know. In the long run, I expect gold versus the dollar will be higher, but over any short or intermediate period of time, who knows? There are many services that try to predict the near-term price of gold, and you can find them pretty easy, but I'm not one of those, so please don't ask me to speculate on the price near term. But long term, I do think the ratio of gold, the ratio of dollars in existence to gold in existence will have to go higher. So the price of gold will have to follow up in terms of dollars. In a moderate to high inflation scenario and low real interest rates, which, you know, the financial repression I described, I expect gold will help you maintain purchasing power and provide liquidity should you need it in an emergency or if you needed to make a big purchase. Now, apparently, many central banks also see the value in gold. Here's a chart showing central banks are buying gold in large amounts. By contrast, back in the days when they were not so worried about inflation, look on this graph back to about 2002, banks were net sellers of gold. Gordon Brown, the Chancellor of the Exchequer for the UK in 1999 to 2002, sold half of the UK's gold at that time, some for as little as $300 per ounce. Not too great a trade, right? Now, these kinds of trends are typically long-term and persistent, so I expect the gold buying trend by central banks to continue, and it should be positive for the gold price. And here's a couple of more indicators of that. There's also growing evidence, some of it, maybe a little bit hearsay, that governments are increasing their use of gold to settle international trade balances. For instance, a few months ago, the Saudis, so I hear from what are normally reliable sources, sold some oil to China and received Chinese currency, the renminbi, in return. And what did Saudi Arabia do with their RMB, the yuan, whatever you want to call it? They bought gold, probably through the Shanghai Gold Exchange, which since it opened many years ago, has sold to the Chinese public something on the order of 23,000 tons of gold. And we don't even know what they sold to non-Chinese. Now, in addition, if you look at the trade between Russia and China, Russia is running a big trade surplus. That surplus is held, so I'm told, in a gold differential account with the People's Bank of China. So it's possible when you look at not just Saudi Arabia, but other Gulf countries, that the trade between China and Gulf states is going to increase significantly. This will mostly be exports of energy from the Gulf states to China, with consumer industrial products coming back to them, exported from China to the Gulf. And very possibly a similar kind of gold differential account would be held between China and the Gulf states. And there may be times when the Gulf countries would like to invest, say, in the bond market in China instead of U.S. treasuries. And if so, how will they hedge it? They'll hedge it in the gold market. So a lot of these issues seem to point back to gold. All right, so now before I wrap up, it's time to go. I wanted to pass on an announcement from Professor George Reisman, who, with the help of an anonymous donor, has made all his lectures available on YouTube free of charge. These are all very clear, cogent presentations on sound economics from a brilliant economist, primarily from an Austrian and objectivist perspective. Reisman remains to this day, in my view, the greatest living economist. So don't miss these if you want to study his work. And the reference down below there is you can just go to George Reisman's blog. You could just search that and go right to it. Go to George Reisman's blog, and the directions on how to get all those YouTube lectures is right there. So I recommend that. All right, let's see if we have any closing comments. Christopher Smith says a big gold theft at Pearson Airport a couple of weeks ago. Total heist. Wow. That sounds exciting. I didn't see that. All right, folks. I've enjoyed it. Hope you have. And with that, I'm going to sign off. I may have to take a 3-week break here because I've got some writing to catch on, but in at least 3 weeks, I should be back and for some more fun and thrills.